Thanks for clicking. Canada's fixed mortgage rates fell in the month of December as bond yields continue to drop, with investors betting that the central banks are going to be reversing course on their path of interest rate hikes sooner rather than later. In fact, with the Bank of Canada raising rates just a few weeks ago, combined with the decrease in bond yields, variable rate mortgages are actually more expensive than that of fixed rates. The decrease in fixed mortgage rates comes as Scotiabank made headlines last week and a bit of backlash after it provided its customers with a cashback offer to lock in their adjustable rate mortgages.
How are you us?
Indeed, a bank offering cashback incentives to lock in, you don't see that every day. So what I want to do today is go over my best year-end mortgage rates for 2022, go over Scotia's plan to entice homeowners into locking in their mortgage rates, and then discuss some implications for 2023. Canada's inflation numbers are set to be released on Wednesday, which will obviously have a big impact on the Bank of Canada's rate announcement set for January. We'll obviously have an update out on those numbers on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. First off, the best 5-year fixed insured mortgage rate. An insured mortgage rate, if you'll remember, is where you have less than 20% down. You qualify on a 25-year amortization. Your qualifying rate is 5.25 or 2% above the contract rate, whichever is higher, and you pay the mortgage insurance. In October, my best 5-year fixed insured rate was 5.04, which bumped up to 5.29 in November, and now has shrunk back down to 4.99 in December, with a 5-year insured variable rate coming in at prime minus 1.05 or 5.4. So 5-year fixed insured rates down about 0.3% from this point in time last month, and about 0.4% cheaper than the current variable rate. 5-year fixed insurable rates are also down this month. Insurable rates, if you'll remember, that's where you have 20% down payment. You don't pay the mortgage insurance, you qualify at a 25-year amortization, and your qualifying rate is 5.25% or 2 points above the contract rate. My best 5-year insurable in October was 5.24. That bumped up to 5.39 in November, and as of December is down to 5.14, with a 5-year insurable variable rate mortgage being prime minus 0.5 or 5.95. So 5-year fixed insurable rates down about a quarter point this month, and currently about 0.8% cheaper than that of variable rates. And uninsurable mortgage rates are also down this month. Uninsurable rates, if you'll remember, that's where you have 20% down. You qualify at a 30-year amortization, or you take money out of your home vis-a-vis a refinance or an equity takeout. Uninsurable rates in October were 5.54, which went down to 5.44 in November, and as of right now are sitting at 5.24, with a variable rate mortgage going for prime minus 0.5 or 5.95%. So uninsurable rates, taking money out of your house or qualifying at a 30-year amortization, down about 0.2% since last month, but about 0.7% cheaper than variable rates are right now. So in summary, fixed rate mortgages down all across the board, and all of the fixed rates are lower than that of the variable rates.
Welcome to the club.
And the spread between fixed rate mortgages and variable rate mortgages is not only going to change the calculus for the average homeowner, the average home buyer, but also for the banks. As mentioned, Scotiabank made headlines last week after one of its branches provided a cashback offer to one of its clients to lock in his mortgage rate. Scotia offered the client a $1,200 cashback incentive if he locked in his adjustable rate mortgage into a 4-year fixed term at 5.47%. The client, understandably suspicious about the apparent generosity emanating from the bank, asked Reddit for advice, after which hundreds of comments appeared questioning Scotiabank's motives.
Well, of course they're trying to screw you.
Indeed, on the one hand, if the Bank of Canada lowers rates over the next 4 years, then that client is going to miss out on those savings that he could have had if he kept his adjustable rate mortgage. But on the other hand, if the homeowner does lock in, they'll have the security of knowing that they can handle the payments for the next 4 years of homeownership, regardless of what the Bank of Canada does. If the bank does raise rates by 1, 2, 3% over the next year, 2, 3 years. Never say never. And I suspect that Scotiabank knows this. That's why they're making the $1,200 bet that the Bank of Canada will eventually reverse over the next couple of years, making that $1,200 bet worth it. Scotiabank might not profit as much over the next couple of years if prime does rise, but when prime does go back down, they'll be better off that the client was in a fixed rate mortgage at that 5.47%. But Scotiabank can make that bet. They're a bank. You or I, however, have to be a bit more careful with our money. We've talked throughout this year about the numerous problems being faced by holders of variable rate mortgages. With the Bank of Canada increasing rates by 400 basis points, a lot of holders of variable rate mortgages had their payments skyrocket since this point in time last year, when, if you'll remember, Scotiabank was predicting an only 1% increase in our policy rate this year.
This ends that.
So, going into 2023, my recommendation is, as it's always been, that when choosing between variable or fixed rate mortgages, you need to look at affordability. If prime rises by 1.5%, 2% over the next 1 or 2 years, which is not out of the realm of possibility despite all of the predictions, affordability should be the number one concern. Are payments manageable if rates continue to go up? If you're buying a home and you're close to that maximum level already, if payments are already barely manageable at that variable rate level, then it might be worth considering fixed. On the other hand, if the payments are more than manageable and you can take a major swing in those payments, then it might be worth considering variable. As always, there is no one-size solution, and it all comes down to the budget and what's affordable. With that said, we'll continue to cover the Bank of Canada's interest rate trajectory on this channel throughout 2023. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.